Folks, welcome. Today is March 17th. It's a Wednesday, and it's time for our midweek roundtable. My name is Roger Scott. I'm the senior strategist for Wealth Press, and I'm here with my usual co-host, and this is Jeff Zananari, and he's the senior strategist for Joy of the Trade. And folks, we've got some really good stuff for you today. None of this is scripted. We're completely live. We don't know what we're going to talk about. And it's just two guys chatting, and we're hoping that you'll capture much of this insight. Jeff, how are you doing today?
I'm great, Roger. Thanks for having me.
Absolutely. Happy St. Patrick's Day. I see that you're you've taken on. It looks great. It looks.
Well,
great.
I'm not Irish, but anything that has luck in it, involved in it, can't hurt.
No, it can't. I couldn't agree with you more. So let's talk about the market. This week, let me start off with the news reports. Yesterday, we had retail sales and we had industrial production, and both reports were, dismal. Terrible. And today we have FOMC. I can't wait what the Fed's going to say. Are they going to stay close? Are they going to keep the same theme? Are they going to talk to me? What are you thinking? What are you seeing?
So this is what's happened in my estimation over the past few days. We've had a little bit of unwind of we've had a new bid in the NASDAQ. A lot of those stocks we talked about that we liked, semis, et cetera, they started to come out of the dumps. People started, looking for value in those names, in the growth names, because relative to their own prices, they were beat up. A lot of these stocks were down 25, 30% from their all-time highs. Like you said, they were breaking down, but invariably people came into them. We saw a little bit of a rotation yesterday, but nothing, just like a couple of days doesn't make a trend, doesn't make a pattern, right? But what we haven't seen is a breakdown in bond yields. So 10-year yields today making new highs on the day of the Fed, which I kind of anticipated with my burn strategy. I saw a lot of these names that were flying high, like tech names, rebounding, thinking that, yields were going to come down. Not so much. We both know, we've been in this game a long time. The market likes to tantrum like little children. We both have kids, right? Like this is going to be a little bit of a market tantrum with the rates until they get everything they can out of good old Jay Powell, like get him to do like it's a hostage situation with the rates. And I don't think just saying you're going to.
I like that analogy. I like that analogy. Like a hostage. You're totally spot on with that one.
And it's like the same thing. It's like hostage situation is always the same. It's like, first give us a bag with $5 million in it. Then we want a private jet fully fueled with enough petrol to get to Venezuela or wherever. And, like the demands keep growing and the market's the same way. It's not enough. It's not enough. It's not enough to sustain that appetite for the growth, for the super juice that we're getting for stock market returns. We're going to demand lower rates, and we're going to have tantrums in the market until we get manufactured lower rates.
Yeah. Or alternatively, the companies and the economy can prove that, hey, we're robust and we're stable and we're moving forward. And based on what you and I are seeing right now, especially yesterday's data, it just doesn't look that way. I mean, in order to have good retail sales, this was the rationale. The $600 the stimulus checks they were given was already spent, so there was no money last month. I mean, that's not how you want. I mean, that's not a strong economy. We
can't need $2 trillion every 6 months just to get people to go to the store. You got to have people working and earning money. And not only working and earning money, they got to be making more money than they used to make just to keep up with inflation.
Exactly.
That's the big thing. People like that are economists. The big thing that was the one big economic thing other than the stock market that was going really well during the Trump years was wage growth was ramping up in a way that we hadn't seen in like 25 years in the United States. So you need people back at work and making more money just to keep up with inflation.
Yeah, absolutely. Now, Biden is proposing a minimum wage hike plan that is going to help in some regards. I don't know if it's going to pass. More than likely it will. But that is also on the table. And I just wanted to mention that because we were talking about rate hikes, and that's something that he's talking about doing. As you know, the whole agenda, help the poor get on track and, kind of put the rich back, penalize the rich for being rich and kind of help the poor. But that's how it is. We can't fight the system.
Listen, there's a pendulum swings, right? The pendulum swings. Ironically, though, let's help. They did this $1.9 trillion, and who's really getting helped? You get $1,400 for a year of not working. I don't know. I mean,
I don't think that's gonna.
I think people like the 20% in the stock market that billionaires and people with 9 digits in their bank accounts feel like more like they're being helped by this 1.9 trillion more than the 1,400 check. But that, I don't want to get into a political discussion about it. It is what it is.
I agree with you. This is definitely not a political discussion. Yeah, I'm just interested in how it's going to impact the stock market based on what you're talking about in interest rates. But I'm
looking at a key level. I'm looking at a key level on yields. So right now we're like at 167 pre-market, 160 on the 10-year. Everybody watches the 10-year. So
yeah, I was going to ask you where we were. I remember the last low was like 1.53. Is that where we're at now? 1.6 something? Because I know it's a new low.
People out there that don't understand how neurotic I am. Like, I'm looking at this number at 3:00 in the morning. I wake up at 3:00 in the morning, go to the bathroom, and I'm looking at that number.
It's driving the market right now.
It's
more than
driving
ever.
the market. So it's like 1.67.
There's a lock right now.
Yeah, it's up 7 bips from yesterday, which is huge, right? Yeah. So that's what you have. NASDAQ is getting sold off. Pre-market, we'll see. Little weak, little languish in some of the high tech names that are interest rate sensitive. But this is I'm looking at if we get above 170 today, you could see the wheels come off the stock market in front of the Fed. Yeah. They tend to shimmy and shift as to what's happening, like specifically in the Q&A. So they have their prepared remarks. And they say what everybody already knows. This is like the least drama ever in Fed actual policy. You and I both know that. We used to live in
every word you're saying. I'm going. He's literally reading my mind. So
do you remember when it used to be dramatic? It used to be like, does Greenspan have a big?
Yes.
Remember people used to put the size of his portfolio.
This is what I'm talking about. This is what Jeff. Don't even get me started. Right, this is what I tell people. I want to play. This is exactly what I tell people that. I'm like, the Greenspan, this guy, you didn't know what the hell was coming out of his mouth. These guys, they can't. I want to play poker with these clowns. They can't hold a secret to save their life.
That's perfectly said.
That's what I keep saying.
You never knew. He was a master. He was a master of suspense. He kept the market always on pins and needles.
Right. Which is good. It's good.
You need it.
Yes.
You need it.
Finally, somebody who sees it exactly how I do.
You need that because then people don't get carried away. It keeps everybody honest. It keeps people.
This guy tells you 2 years in advance what he's planning.
That's why you're getting these bubbles, frankly, and that's why you're getting these violent moves in rates, et cetera. It's because everything's too telegraphed, in my opinion. If he was a little less telegraphed, a little less this, there would always be like more of like people not getting carried away. Ebbs and flows.
Yeah,
and people get carried away.
These clowns, they're putting themselves in a corner every step of the way. I couldn't agree with you. And you know what's interesting? Nobody else is talking about this except you and I.
Well, nobody else has been around that long, Roger. We're old heads.
Yeah, I always say Greenspan. You never know.
I'm kidding.
He had the best poker face. These guys, it's like a year now. We're not going to do anything for the next 3 years.
We used to analyze how he was walking into the Fed Reserve building. Like, what was he holding in his hand? Did he have a coffee? Was he holding holding just a folder, or did he have a briefcase? Like on briefcase days, that's you could count on a 25 basis point hike. With the little folder, nothing's going to happen. He's going to be dovish. Like it used to be that psychotic, and now it's like, all right, maybe in 2024, 23, third quarter 23, we might raise rates. So there's no drama.
No,
but the market is holding him hostage because they want to say we have instruments and tools we can do to make sure rates don't go rise. We will interact in the open market and buy bonds and commercial paper and corporate debt to make sure yields stay up. Like, they want to hear that we're going to do new stuff because we already know everything else they've got, which is like what you're saying. They show too much.
Before we move on from interest rates, do you believe that by the end of the year, we're going to be at 2% or higher?
No. I think we might touch it, but I think that these guys are they're so hostage to. I think if we get to 2, I think once we level above 1.7%, you're going to see violent. I think it's going to be a year of violent corrections back and forth with an upward trajectory, and that's going to be the $1 trillion question. Whether if they do, surrender to the Fed, to the market's tantrum, to the demands, and do these crazy new things to keep rates at bay and introduce Operation Twist 2.0 and whatever, like total Japanification. Those of you that don't know, Japan like buys stocks, they buy ETFs, they do everything to make sure rates don't go up, make sure their currency is weak, and make sure stocks stay okay. But the Fed isn't really there yet. They're like 70% there. What I think is going to happen is if we start creeping towards 2, you're going to see the Fed totally go like throw the kitchen sink at keeping things okay. We're beholden to the stock market in this country. It's baseball used to be the nation's #1 pastime. Now it's the stock market.
So true. So true. I talk to Tony Saliba all the time, and he owns a brokerage firm. And he tells me that the number of applications coming in is he's never seen anything like this. Chicago Board of Trade, not Chicago Board of Trade. What am I saying? CME, Chicago Mercantile. You could tell how old I am. Chicago Board of Trade, Chicago Mercantile Exchange, and Chicago Board of Options Exchange are both near 52-week highs right now. So CME, yeah. Do you think? What do you think about commodity prices in general? The CRB in terms of the overall structure. I'm not going to talk about plastic or any of that, but generally speaking, do you think we're going to have? Me as well. I think.
Listen, we're getting the whole playbook. We're getting the whole Democratic play. Like, you don't want to make this a political discussion, but what happened in the Jimmy Carter years? What happened when they had Democrats running the Congress, Democrat president? They had crazy inflation. They had gas prices explode. They had like wild stuff happening in commodities. It's even crazier now because it's not just an American thing. It's an around the world thing. I think in terms of gas, the only pressure from gas is technology, electric cars, less demand, et cetera. People being able to work from anywhere. That's going to create like a wet blanket for that one particular commodity. But in everything else, like, it's unbelievable the demand that's out there for everything. People want to take this money, this liquidity, this money they can borrow, this ATM machine they're using in their house, and they want to turn it into stocks. They want to turn it into home improvements. They want to turn it into the new cars. They want to turn it into everything that you can buy that you can touch.
Agreed with you. What about real estate? What are you thinking in terms of real estate? Do you think we're going to see we're going to start seeing a cool off because of rates, or do you think we're going to continue seeing the stability because ultimately we're still near 3% in the big scheme of things?
I think real estate's going to continue to explode. I think people always say, we're in a bubble. It's like, okay, you've identified a bubble, but bubbles get so much crazier until, and I'm talking local. Like, you can only think locally. Like, we live in Florida, so I'm skewed by Florida having probably one of the best real estate markets in the world right now. But I'm bullish even here because we're still at levels that if you compare, where we're at, where you're at, to world cities, we're still like very fractionally priced to California coast, fractionally priced to these places. Yeah, you could argue subjectively that's a better area, this is a worse area, but that's neither here nor there. The bottom line is that this is a state that a lot of people want to move to that have money for a variety of reasons, not the least of which is political, right?
And state taxes.
It's money. It's political.
Yeah.
It's because it's easier to own a business. It's much less cumbersome. There's less regulation. It's easier.
Great place to be. Really great place to be.
So it's attracting people, right? But so what I'm trying to say is, I think rates are going to stay okay for lending because banks are going to still continue to want to make money, and they're making a tremendous amount of money. So there's still a lot of meat left in that spread. But we've had basically like years and years and years of people sitting on their hands doing nothing in real estate. And now everybody's like, they've been like propelled into motion to own, to upgrade, to do stuff.
I had dinner with somebody the other night, somebody who's visiting Florida to do a presentation with me, to do a class with me. And this gentleman owns substantial real estate, apartment buildings and so forth all over the country. And he's telling us what we're seeing here in Florida is also happening in parts of California, parts of New Jersey, parts of Hawaii. So it's definitely very, very, very broad. And I believe, based on what I'm seeing, I think we are going to see exactly that. I think we're pent up. I think this new catalyst with people working from home, even though people are still getting out, the mechanism by you can't stop progress. And a lot of companies are saying, hey, you know what? We kind of like this work from home idea. even though you can go somewhere else, you could still work from home. We may cut your salary a little bit, but we'll allow you to move to Florida or Texas and so forth, save a little money, give you a benefit. So I think that is going to continue because people kind of liked what they saw. They got a taste of the stay-at-home environment. And I think that's not no, I don't mean stay-at-home environment in terms of not going to concerts. I'm talking about work.
Yeah,
I'm being very specific. I'm talking about the flexibility of working from home.
Taking your kid to a soccer game at 4:00 that you would have missed if you were on a train coming home at 5.
Right. And people, people were very concerned about the quality of work, but it seems to be working out. Companies are finding a balance for themselves, and it seems to be working out well. And I'm seeing this trend continuing. If that happens, there's going to be a lot more people relocating, moving around.
Look at the Homebuilder stocks, Roger. We both recommended these stocks in the beginning of the year. I think interest rates have exploded again, and these stocks are not pulling back. If we get a pullback, if we get interest rates go from 1.7 down to 1.3.5, what do you think the housing stocks are going to do? They could go up 50% from here. Those stocks.
Yeah.
There's a pent up demand. There's a backlog. You can't get a builder in my neighborhood. You can't, there's a waiting list for new houses. There's waiting lists for everything that has to do with the houses.
When I moved here, and I'm not in Miami. I'm in North Florida. This is not like this is not a hot spot.
It is now, though. It wasn't when you moved there, but it is now.
Well, so let me tell you this. When we moved here, the average home was on sale for 6 months in my subdivision. And I thought I was overpaying by about $100,000. The prices doubled, and now homes are on sale for 3 days. It's madness, and obviously there's no supply. So yeah, I mean it's craziness. It's craziness what we're seeing here. And again, I'm not seeing it stop anytime soon, just like you. So it's very interesting. You get
to the point where you're like, okay, I have like all I can eat in stocks in my retirement account. I have a lot of stock. I have a lot of exposure to the stock market. My wife has this. I have this. Like there's so much stock exposure that you have besides the trading strategies. And then you're just like, do I have a like expensive enough, nice enough, big enough house? Should I upgrade? Like, should I do better? You always, like the trader in me was always like been like a little bit like modest. And now I'm thinking to myself, like, like you should blow it out. Just get the baddest ass house in Miami. What are you doing? It's just like, like you could do it. Why not do it? And then it's just like, you think about it and then you're just like, everyone's having that thought, Roger. Everyone's saying, I should have bought that vacation home in Vail that I love. Yeah. I love skiing. Why didn't I buy that vacation home? People in New Jersey are like, why didn't I buy that condo in Sarasota or Ponte Vedra?
Very true. Very, very true.
And now they're acting on it. The difference is before they used to think it. Now they're like, give it to me. I don't care.
And I think as the economy opens back up and as people feel more confident about going back to work, and they're going to take advantage of this. This is not going anywhere. Agreed. So I wanted to see where you think there. Now, we've got something big happening tomorrow. We've got two big stocks, two very separate industries reporting earnings. We've got Nike and FedEx. Do you have any specific opinions on either or the industries or the general direction of these two? It's interesting because one is a big transport stock, and the other one is a big retail stock that actually was able to do fairly well. Nike did fairly well throughout this stay-at-home environment. A lot of retailers sold online, and obviously people are not going to stop buying Nike, and people are not going to stop using FedEx. But what's your thought if you have any thoughts on these two specifically? Because a lot of people are asking me about it. It's two big companies.
FedEx, I'm very bullish on FedEx just based on the fact that, like there's been activity, there's the reopening is happening, but people are still like dependent on things being delivered to them left and right. Like, I take for granted that a lot of people are still locked down at least 75% of their lives. So FedEx is going to probably have a pretty strong number. Nike is Nike. Like these companies always beat it, on Bloomberg. You can go back and you can look. I will say this, FedEx, I'm focused more on. If FedEx has a bad number, because they're a bellwether for what's going on in like the whole planet. If FedEx has a bad number, we're going to be in deep doo-doo. I think that could affect the whole stock market.
Yeah. And that's the reason why I'm specifically talking about these two companies, because they're so instrumental in so many different ways. They don't just talk. It's not just a focus on the individual stock. FedEx is going to reflect on the transports, on demand, on a bunch of stuff. And same thing with Nike on a different level. Now, I looked at the numbers and I agree with you. I think they're both going to beat. but I'm not as bullish on FedEx because I think they're over expecting.
That could be true.
Not because they're not going to do well. I think they're going to kill it, absolutely destroy it. But I think their expectations, I think they were not hoping, obviously they weren't hoping, but I think they were planning for a longer stay-at-home environment, which would obviously propel more sales. But look at Amazon. Look at all the retail stocks. They've been going crazy. And now,
look at this. Check this out.
Yeah,
I've got FedEx's earnings per share. They beat 11 out of the last 13 quarters. They beat 11. They met 0 and they missed 2. Yeah. And their average beat is by 20%.
Oh yeah,
I don't know what the stock's going to do right now. It's an implied move of 6% for one day, which is high. It's
been very volatile the last few days in anticipation, but it's been cooling off. It hasn't been doing as well as. I'm going to check Nike. Do you have that info for Nike as well, Jeff?
Yeah, hold on. Nike. I just bought my kids some Nikes. Everybody's like, so Nike beat on 6 of the last 8. Average surprise is 25% higher. Average implied one day move 5%.
They're very similar in terms of their moves. They're both very, not the companies, but in terms of their movement and so forth. And they're both kind of right above the 50-day line right now.
Yeah.
But I'm watching those carefully. Anything else on your horizon? What's the game plan for the next few days? Give us an idea of what you're looking at so people can get an idea of how to analyze the market specifically over the next short term, next 3, 4, 5 days.
Today's a big day. Watch what happens this afternoon. If we get oversold again, you want to see a bounce back immediately, like in the aftermarket. You want to see a flush. If they don't like what Powell says today, look for the NASDAQ. A 1% down NASDAQ day doesn't do anything for me. 2% plus NASDAQ down day is a bit concerning. You want to see the follow-up day be a rebound of at least half of that back. So tomorrow, if that doesn't happen, then you could see some more bearishness in tech and the NASDAQ. Russell had a bad day yesterday with not much news, which was kind of concerning, down 1.5% to 2% most of the day, while NASDAQ was a little bit up. S&P was like kind of unchanged. So let's see what Russell does also. I'm looking at Russell and I'm looking at NASDAQ tightly. S&P is kind of a nothing burger. It's just like, very small moves, low vol. And VIX. Will VIX be above 20 or below 20? Yesterday, something really profound happened in VIX. We touched a level we hadn't touched since pre-COVID.
Right.
And so let's see if they can maintain that.
Yeah, I'm glad you touched on VIX. That is very, very important. It's the first time that's happened pre-COVID. So that is very significant. S&P and Dow started trending. They are near all highs, but they're coming off now. So what I think is going to happen is, because the NASDAQ is the lagger right now, not the leader in out of the major indices, I think we're going to see a few days of a down move in the Dow and the S&P, simply because we've been going up so much so fast in the last few days. Yeah. And that's going to bring the NASDAQ with it, because that's lagging behind and the lagger always comes down.
Right.
So aside from not bringing interest rates into this equation, I think just by simple short-term relative strength, we're going to see NASDAQ come down, because if the S&P and the Dow,
we're due for everything taking a breather.
Yeah,
we're due to it for 3 to 5%, not like a crazy correction, but 3 to 5%. But I think it's going to be a lot of those kind of moves.
Yeah. But in terms of interest rates, I'm very, very interested in seeing. But again, I think we've got these guys in a corner, and I just don't know what they're going to say, and it's really going to be interesting.
He needs to do more. It's like the treadmill keeps going faster. That we know. He needs to do more. It's not enough. It's never enough. It's a tantrum.
Any particular linked trades that you want to talk about that you closed or you're looking at? Any relationships?
I got a cool one that I've done recently. It's not like the newest one, but it's pretty new. Long silver, short gold.
Oh, listen to you. Oh, yeah.
SLV, long SLV, short GLD.
I like it. I like it, Jeff.
Yeah, GLD is, we get that big rip in the in interest rates. GLD is going to get hammered, but SLV is going to stay with this economic pattern, and the rest of commodities. They've decoupled, and SLV is kind of traded more with the broad Bloomberg commodity index than with silver. So I'm playing that spread.
I like it. I like it. Question for you about that. Were you, when you put that spread on, were you considering, instead of doing the long side in silver, doing it in copper? I like it. I'm just asking because I'm kind of, that was the first thing that came into my mind, because
but I'm using ETFs, and I don't, I'm using the actual commodity ETF. I'm not using miners.
Gotcha.
So that'd be an interesting mining.
That would be an interesting miner. Yes. That would be an interesting. You got my wheels turning though. Yeah. Well, that was the first thing I thought about when you're like, silver gold. I'm like, I like that. I wonder
like
how
a long Rio Tinto or BHP and short Newmont Mining or something.
Exactly.
That'd be a great one.
Folks, something to think about. Got
to go dig in and see when the timing of it would be good.
I knew I would pique your interest. Jeff, I don't know where the half hour goes. I start talking to you. Next thing I know, I look at the clock and half hour just went by like that. I mean, I love it. I love it.
Awesome talk, Roger.
Absolutely. It gets better every time. Folks out there, if you want to reach out to Jeff, please do. He does not bite. Not at all. Jeff at joyofthetrade.com. That's Jeff at joyofthetrade.com. All feedback is welcome. And if you want to reach out to me, the quickest way to reach me is support@marketgeeks.com. Again, Jeff, thank you very much for spending this time with me, and I will see you later on in the week.
Yeah, Roger. Have a great Wednesday. Happy St. Patty's, guys. Drink.
Bye, everyone.
Have a drink.
Take care. Thanks, bud. Take care. Bye.
Take it easy.